Okay, drop me a message if you need help. Okay, tonight's sessions is an ongoing session, part of my Thinking Traders series. Why Thinking Traders? Because end of the day, I notice a lot of you are having problems understanding trading. A lot of you like to trade system. I would like to trade methodology. A lot of you like to trade A plus 1 plus 3 equals to G or like that. This is what I call system trading. Okay? System trading. Nothing wrong with system trading. Okay? However, okay, the problem with system trading is what? They are dumb. Mean dumb what? They don't take into account of market, what you call market, live market condition. This is my live record. Sorry, this is my contact details. Anybody need any help? Okay, please send it. Please drop me a message. I'm more than happy to have a WhatsApp or nice conversation with you if you ever need help. Today's talk is directional trading. Okay, please bear with me for about 20-30 slides. I go through fast one. Okay, by 11 o'clock or 11:15, we will switch over to the live market component. Means what? I will use live market data, pricing, chart patterns to explain to you what mean by trade risk less, profit more trading style strategies. Disclaimer here. For those who don't know my background, this is my bio. I am a portfolio trader. I trade all time frames. I use multiple different instrument strategies, time frames, and I trade forex, futures, options, FX concurrently. To me, it's not a. To me, trading is just driving a car. Any car is a good car if you use it correctly. So let's talk about directional trading. Directional trading is what I call, okay, normal market trading. Okay, what is normal market trading? Normal market trading is referring to what I call predicting, forecasting, market directionality. Whether is it bullish or bearish. Bullish, you buy up, long. Bear, you buy down. In this case, shorting. These are the most common. These are the most common form of trading. Okay, nothing wrong with it. It's excellent. But the main issue is that you need to predict and forecast the market direction. Here is a nice chart dated 30th November last year. Okay, this is what we call a normal the FX directional trading. This is Aussie USD. On 30th of November last year, it looked like a bullish directional trade. You're based on the chart patterns analysis because this is a bullish directional trade for 60 days. We are basing on a 30 days low. Yeah, 30 days low here, minus a bit more to compensate for market noise. Can you all hear me? Hear my voice? Please type yes if you're able to hear me. Good. So this is a compensate for noise. So you cannot use a 30 pip stop loss or 5 pip stop loss if you are going to do a 60 days trade, correct? Your stop loss, like for directional trading, like all direction must be determined by the underlying, and the duration of your trade. Let's say you trade Euro USD now. Your stop loss for let's say you want to do a swing trade of 10 days. Your stop loss must be at least 140 pips or more. 140, 150 pips. Why? Because your trading day is 10-day cycle. Every day, every day Euro USD is moving around approximately around 74 pips a day. 74 pips a day. You cannot telling me use 30 pips. If every day the trading range, what I mean by trading range here, can you see the candle here now? This is what I call every candle. Every candle presents a trading range. Okay, there's a formulation, you work backwards, go back 8 candles or 10 candles or 3 candles, what we call, okay, to create what we call a price action value. Price action value is exponential weighted average of the last 8 candles. If the daily candles is 74 pips a day, every day average movement 74 pips, and you want to do a trade, to hold a 5-day trade, your stop loss cannot be less than 180 to 100 pips. Why? If you put a 10 pip stop loss when you hold a trade for overnight, you'll be stopped out within 1 hour by market noise. So here we got price action value now based on the chart pattern. You see the stop loss for electricity trade is 160 pips. Based on how many days? Based on the 30 days, about 23 weeks low. So as a trader, that in today's session is to focus how to risk less to make more. Okay, to trade Aussie USD, there are approximately 6 different instruments you can trade. 5 lah, okay. Spot forex, mini lots. Spot forex, standard lots. You can trade Aussie USD, okay, /XA futures, 1 contract, 100,000. Then we got FXA, the exchange traded funds, which hold physical Aussie dollars, 100 shares, $10,000. Then we got options on futures, options on ETF. You can see from here, yes, there's so many different underlying available for you to trade. Even on Aussie USD, it can be Euro USD, it can be oil, it can be crude oil USD, it can be gold USD, it can be US shares. No much diff. But the emphasis of this slide is to emphasize the nature of different instruments. Spot forex and futures, look carefully, is margin trades. Margin is a deposit for the underlying. For example, a trade mini lot, you need a 50 times damage, you need $200. But you put $200, your risk is not $200. Your real underlying value is 10,000. You put $2,000 is not your real risk. Is this your margin? It's a deposit. I will explain more later to you what is leverage and margin later on. The rest you see here, Aussie is $7,300 US to buy $10,000. This is one-to-one exchange, no leverage. You are holding real Aussie currencies, what we call treasury companies, bonds, and bank deposits. Options you buy is $1,100, is no fixed capital. Means what? You cannot lose more than your initial capital. While if you trade margin, your initial capital, so-called your initial margin capital or deposit capital is 200, 2,000, and 1,400 is just a deposit. Any questions? Any questions? So next start, risk more, profit more trading is actually a form of trading that use various trading strategies or underlying to keep your trading capital exposure to as little as possible. If you go put a trade for $1,000, you do need a stop loss or not? Maybe. If let's say do a trade for $10,000, 1 mini lot, definitely need a stop loss. But if you go instead of doing a $10,000 trade, you go and buy a derivative instrument for say $150. Maximum total capital, maximum total risk exposure, capital exposure. Do you need a stop loss or not? That is what I call today's session about. Today's session about is showing the different strategies or underlying, depending on the case, what you're looking at, to minimize your trading capital to as little possible. When I say trading capital, I'm referring to your real underlying value, and the real underlying value. I'm not talking to your margin. Margin is just a deposit. So let me explain to you what is margin and leverage. Leverage margin is based on money borrowed by your broker, extended by a broker, to allow you to leverage, multiply your funds to trade much larger trades that you can afford to risk. Okay? Now, means what? Your account $1,000 with 100 times leverage can trade to $100,000. If the market move against you 0.8%, you'll be stop out. Even you have no stop loss, the broker will stop you out because your capital is only $1,000. Okay? And by the way, please do not believe in this urban legend, traders legend. Oh, Thomas, you cannot lose more than $1,000, but you can make money on 100,000. Or some case, if 500 times leverage, you put $1,000, you make money on $500,000. Your maximum loss is $1,000 only. That is not true. I repeat again, with a real proper broker, no such thing as make money on $500,000 trade and maximum loss of $1,000. There is no such trade around. The only brokers let you do such trade around are what I call third world brokerage house that out to con you. Any questions about leverage and margin? Okay, thank you, Dave. Now, next thing, Thomas. Before we go further, we need to talk about different time frames for trading. Why? Let's say you do intraday trading, intraday scalping, or you do a 30-day swing position trade. Every time frame or every trade duration you do have a different stop loss number, different stop loss value. Okay, let's say now, Thomas, I want to Euro USD scalping. Okay, every day move every day I know for the last 8 days before yesterday, based on yesterday closing price, 74 pips. For let's say you do day trading, what is the stop loss going to be? 70 pips, 80 pips? No. If you're going to do an intra-week trade means that intend to hold for 5 days or more, your stop loss must be at least 120 pips at least. Correct. But if you do day trading, if you go put 100 pips stop loss, I think it's too much, because every day average out high-low range, okay, high price, low price action value give us a value of 74 pips. If you enter a trade in out 3 hours, why the hell you use 74 pips? You use too much. Correct. Okay, you use too much. On the other hand, if you want to do a 5-day trade and you put a 30 pip stop loss, I guarantee you'll be stop out before, even if the market moves your directional. So every time frame has its trade. Intra-month, more than 7 days, less than 1 month, less than 30 days. 30 days to 90 days. 90 days to 1 year. So every time frame must have a stop loss. These are the most popular trading instruments in the world, currently in the market now. Shares, you can trade cash or CFDs, spot, forex, indexes, gold, crude oil, or you call private leverage instruments. We got option trading on futures, FX, and indexes and shares. Then we got futures options. We got futures trading itself. Today's talk will be focusing on how to do a trade with as little capital as possible without leverage. Because leverage, I just imagine, you put in $1,000, you can trade 100,000. Some of you I know got 500 times. If got be certain Russian brokers can trade out to 5,000 times, means that your $1,000 can trade out to $5 million. So before we go further, let me run through some examples of normal directional trading. Here are some examples with US shares. Okay, US shares trading, you can use CFD to trade, but whatever it is, it's going to be expensive. Like here, like that, $5.63, 2,000 shares. It's not very much, about $11,000, $12,000. The problem is what? You can make money up. Buy 53, take profit 91, take profit 93. So make 30 cents in how many? 1 hour. Here, overnight trade, make $1.18. So all these are what we call normal directional trading. This is what? This is bullish, this is bullish, this is bullish. So let's go to the next shorter time frame. For those who are into scalping, by my definition is referring to an intraday or intra-hour trading. Here's an example. This one is done using futures. I use futures. This is my personal trade. I use futures because I'm much more comfortable with futures. I have more importantly, it's more to me. I feel much more transparent, much more accountable. You see now, enter the first trade. Enter on 851. This is by the way euro. /6 is a euro. Each contract is 1.25 standard lots. Enter 851. Take profit. Last take profit 903. 12 minutes. Do remember, ladies and gentlemen, when you do intra-hour scalping, it's no longer what we call system trading. Okay, it's more, the shorter the time frame you trade, the more skills you need going to be. I repeat, the more skills you need going to be. Okay, it's skill-based trading. Price action skill-based trading. So of course, if you trade intraday, yes, it's easier to trade because you got more longer time to enter, more longer time to take profit. Scalping, 12 minutes, very fast. Must be precise, must be skilled. This trade here is what we call intraday trading. This one is my style of trading. Basically, I enter this one is euro trade also. Enter the beginning of this year. I enter at 1.39195. I put, okay, sorry, I long at, okay, I long here. Sorry, I shorted here. I shorted at 1.1391. I took profit 1.3951. 40 pips. Notice my order, I put a trading stop order. Here, these shares, also same, 1 hour stock trading. The best form of trading to me now, the market with the highest volatility, on what we call in terms of percentage basis, is US market shares. Forex is not volatile at all. Forex is only volatile to you because you all use high leverage. Be honest, 74 pips is less than 1 cent. In terms of stock share trading, I think in terms of $5, $6, $3. Okay. Here's another one. This one NQ. Okay, this one let me explain to you why trade. This is an intra-hour trade. Look carefully. This is a margin trade. Each contract is Nasdaq 100. Need $7,000 to do. So I shorted 4 contracts of this. Okay. Okay, at 11 o'clock, I took profit. By 12 o'clock, I took profit all back. I made $3,200. Thomas, $3,200. My margin requirements is only $28,000. But what is the underlying value? Underlying real acknowledgement value is 54,100 units. Remember, each unit is 6,762. Okay, each contract represent each contract represent 20 units. So you can work out the numbers. You see, you can mix up $3,000, $16,000 type numbers because of you're using high leverage. Buy 5 contracts, enter on the 12th, take profit on the 17th, $16,000. But you have look carefully. Duration is 5 days. Nice. What is the real value? The value is 71,600 units. Okay? Because I got 5 contracts here. Each contract represents 20 units. 20 units of Nasdaq 100. So it's 20 units. 5 times 20 is 100. 100 100 times 7,151 is around 171,000 sorry, $716,000. Any questions? Of course, high leverage are also good or bad. It's a nice here's a nice losing trade here. Don't worry, Aaron. I will show you a simpler form of trading that need less money. Either if you don't have enough money, you can compensate for your trading by using spot forex or CFDs by using higher leverage. This is an intra-month trade. I buy 4 bitcoins and I lose $18,000 in 22 days. Okay? Here is another trade using option derivative. I show trades on shares, I show trade on futures, now I show trade options. Option trade, buy Boeing for $3.32, take profit at $29.45. Buy 328, maximum risk is $322. Maximum profit, I make $2,600 for the trade. This is another one. Buy 126, take profit at $6 and $8. Sorry, I skipped a fast one. Okay, I don't focus much on slides, I want to focus more on live market later on. Illustrate $265. Okay. In 28 days, I took profit for buy 260, buy 263, take profit at 920, 965. All these are, look carefully, maximum risk per contract. Means that without stop loss. Because this type of strategy using options, I prefer using what you call trading strategy using stop loss money to trade, or you can use prefixed capital to trade. So I repeat again, currently a lot of you use high leverage or use margin to trading. CFDs 5 times, 10 times, put in $10,000, you can trade up to 100,000 US dollars. Any decent broker, any decent Singapore brokers will give you that leverage. In fact, any broker will give that leverage for share trading and share trading. Index trading 20 times. For gold, 50 times, 100 times. Forex, 50, 100, 500 times, 1,000 times. My advice to you, ladies and gentlemen, for those people who trade Forex, unless you are very skillful in what you're doing, try to focus it on 50 times or less. Stop. I hope you all pay attention. This is something of great interest to you all. Here are a few different strategies to set stop loss targets of value. Will you be interested to know more, for me to spend more time on this, or for me to run through it fast? Okay, so we got mix a bit of time. Okay, fine. So stop loss value can be divided in many different types. One, Thomas, like forex trading, you cannot risk more than 2% of account value. Stop loss value, okay, nothing wrong with it. Stop loss value means that you open a nice big position, use like high leverage, then you put a stop loss inside to trade. Fixed dollar value, okay, 1, 2%, 3%, 5%, depends on account size. Then fixed dollar value is best used for option trading. Thomas, every trade I go in, I prepare to lose $200. Or every trade I go in, I prepare to lose 30 pips. Currently, all these stop loss value have nothing to do with option trading yet. You can base it on the you can base it support recent nice. Some people moving averages. Thomas, I will move moving averages. Use moving averages. 30 days moving averages for day trading. 10 days moving averages. Price action value is referring to the last 5, 10 candles, high low, what we call the trading volatility of underlying. Option premium analysis, this is more advanced, to use option premium pricing projected to the period of time you want to hold the trade. Because options underlying is based on what we call forward expectancy. ATR. Okay, Thomas, I use 14 days ATR times 2. Can? Trading channel. Okay? High low range, okay? Multiple time frame analysis. Thomas, I enter a 1 hour, I set my stop loss based on 4 hours candlesticks. Can? Thomas, I enter my swing trade on one day, one daily candles, but I set my stop loss on weekly candles. Also can. But somebody said, Thomas, every trade I enter, I prepare to lose 5% underlying value. Some case for forex, maybe 2%. For shares, depends what. 5% for Facebook, Amazon, not enough. These are the 3 different style of trader: hunter, fisherman, farmer. For those who are familiar with it, hunter is a day trader, day scalper. Fishermen are those swing traders. Both a hunter and fisherman are directional. Farmer is option trading. I don't talk too much, right? It's passive, non-directional. Do not need to use chart patterns. This is one of my trade open on 2nd of March before I open up. Okay, before I go for my holidays last Friday open this trade up. Before I go for holidays, we will look at this trade and see how much money we make, how much money we lose. I just came back from my Chiang Mai holiday this afternoon. I have no idea the performance yet. Currently now, whatever I do now, wherever I trade semi-automatic or semi-automatic. I don't believe in robots. I don't believe in EA. So 18th of April, 57.50 put, cost me 158. Okay, what time I enter? I enter at 12:30 on 2nd of March. Any questions so far? Yes, these are options. Why? Look carefully. I put $1.58. The share, which I'm trading is about $59. If I short $59, that means that my trade position so-called capital at risk, if I short the mother shares, will cost me $5,900. If I buy an option, it will cost me $1.58 only. So which one better? It's up to you. Any more questions? By the way, 158 is maximum total exposure. Times $100, 100 units is $158. Any questions? Before we go to the actual market popper?